traders. Gary Wagner here just before 10:30 in Honolulu, 4:30 in New York on Thursday, the 12th day of June 2014, and this is the daily report for gold and silver. We have a mixed bag in the precious metals markets, with gold and silver trading sharply higher and platinum and palladium trading sharply lower on the day. To gold, current print, as you can see on the screen, is $12.72, $12.73, puts it up roughly $12 on the day, just off a high of $12.76 even. The low on the day, $12.59.60, a percentage gain of almost a full percent. Silver also moving sharply higher, actually up 1.75% on the day, sitting currently at $19.51. That's off of the high of 1967 and a low of 1909. More on silver towards the end of the show. I kind of want to pick up where we've left off over the last couple of days. And we've been talking about the fact that, first, we absolutely found support. We found support above 1232. I believe that to be a pretty critical number. We're looking at a daily chart. Let's go ahead and blow that up a little bit, because what we have really seen is that the nature or the characteristics of this current rally has really been defined in the following way, and that is we get a price ascent, sideways trading activity, we get a spurt, sideways trading activity, and then today we got a spurt. So we have seen this market move up, I believe, in a very orderly fashion, because we talked about the other ways, which would be a typical stair step, up $1, retraces 30 cents, up another dollar, retraces 30 cents, or a parabolic rise, which we expect a parabolic crash. Of the types of rises, this to me is probably the most orderly, in that what we're getting is, as the price moves up, and the fact that we don't get any kind of sizable retracement tells us the market is consolidating. It's a rest period prior to moving up again. And so we've seen that now over the last, call it week and a half, since this market really began to rise. And this is back Thursday or a week ago, Thursday of last week, then Friday, Monday, of course, and so forth. Now, we're getting near our first target in which we want to look to potentially either trail stops up very tightly or pull profits. And we'll talk about the different strategies throughout the show. Now, the other thing that is noteworthy and worth pointing out is the fact that we have really moved above that 14-day average. If you recall, we made the assumption that we would move above it. Silver had moved above a 14-day average, but yesterday we were trading just at the 14-day moving average, and that was also a fairly important level, the 61% retracement. We'll talk about that when we pull up our weekly chart that has our fib retracements on there. And it was my belief at that point that we should be able to get through that fairly easily. And if we were going to run in some resistance, we would probably see resistance coming in roughly at the mid-80s level. And the reason that I'm looking at that is twofold. One, we have a 50% retracement there. And two, if we look genuinely at the bodies, as this market traded sideways, these bodies were all above that particular price point. So, as we've talked about, one man's ceiling is another man's floor. Resistance and support are part and parcel of the same thing, and it really depends on where you're standing in terms of the structure. Are you on the second floor looking down or the first floor looking up? Now, I've gone ahead and I have converted our daily chart, which was in standard Japanese candlestick format, into our Japanese average chart so we could take a look at it. Now, here's what we're noticing. Very nice body size. You can see the body size has increased and has increased steadily, first of all. Second of all, there is that absence of these lower wicks. We've had that not only today, we had that yesterday. And you can see that these were very small bodied candles as we hit this pivot point. You can easily now see the pivot point now that we've gone past it a little bit, because we had these red candles begin to wane or shrink in size. That told us that the downtrend that had been prevalent had been really starting to lose its power, and we saw the pivotal point in which we went from red to green, small bodied in both cases, but we've had this steady increase of body size. Body size is now good, absence of lower wicks, and that tells me that the trend that we're witnessing is still intact. However, one caveat with that, if we look at this dramatic rise here, you can see that all the way up to the point in which the market came down, we had decent body size and the absence of those lower wicks. So we don't always get fair warning, so to speak, in which we get those pivotal small-bodied candles at the end of a rally or at the bottom of a correction. Next chart we want to look at on today's show is this 2-day chart, spot market of gold. And there we have a couple of the different fib levels that we want to be looking at. This is at 1232, of course, and you can see that the market, in essence, hit that, found support, and moved up. Even more interestingly is we've identified a pattern in the weekly candlesticks, and in the 2-day you can also see it, and that is that 3-river morning star. It is a pattern that we see time and time again. It's a key pivot reversal pattern, and you can see when we look at this particular chart, the market comes down, you have a long red candle, you have a star gapped at the bottom, that's followed by a green candle. Now, in terms of body sizes, when you compare it to the downtrend that we had, they're not that large, but they are relatively large body sizes when you compare them to some of the sideways action we saw just prior to us breaking below the compression triangle. If you recall from yesterday's show, and actually over the last couple of days, it's been my belief that we wouldn't have too much problem really breaching this 1262 61% retracement. We've done that quite eloquently, and so our next real target, next real level that we're looking at is going to be about 1287, 1288. 50% retracement, and then above that, of course, would be 1312. That is a 38% retracement in gold. Now, when we look at our weekly candlesticks, and that's what we have right now, if you recall from the last couple of days, I drew in, and I also claimed for illustration purposes only, that we really wanted to see the size of this candle begin to grow. We've actually gotten that, and this is about what I was hoping to see within the market. So we've got this classic pattern right now, the 3-river morning star, our red candle down, our pivotal candle in the center, and now our green candle, because that could be signaling really a key pivot point and could be pointing to much higher pricing. I draw your attention to the one rally we had at the end of 2013, beginning of 2014, and that pattern, if we look at our weekly chart, started exactly the same way. Red, although the reason I'm calling it a variation, this really isn't a true star, it is a small-bodied candle, and it's followed by this large green candle, and from there, we were pretty much up and away as the market went to 1391. Now, in terms of the marketplace itself and your current trade, I feel comfortable in the fact that we closed above 1263. For those of you who want to play it safe, you can put a price order in to actually get out at, call it, I would put it in anywhere between 1283 and 1285, hoping that the market comes up, finds a little bit of resistance, comes down. The caveat to that kind of a strategy is if the market just barrels through. And if that's the case, you can just get in, of course, again, at a higher rate. I don't think that there's ever a wrong strategy taking a profit, but the fact is we always want to maximize the profitable trades we have, minimize the trades that are losing trades or our drawdown trades. We've definitely got a profitable trade underway. So depending on your aversion or your aversion for risk and what you're looking to get out of this trade, you can act in a couple of ways. One is simply to put in a price order to exit that trade, as I said, 1283, 1285, somewhere in that area. The other way is if we get a continuation, you'll place your stop under 1260, let's say, and that way if the market continues to move up, you would continue to trail your stop higher. Under this scenario, if the market in fact continues to move higher, your next level to trail your stop up would be after it broke above 1288, and you'd want to put your stop at about 1283, looking for your next target of 1312, which is the next fib level that we have identified. In either case, there's caveats to both and there's advantages to both. Of course, the caveat to trailing your stop up is if we trail our stop up to 1263, it hits the high at around 1288 and then begins to back down and stops you out. You've given up that $20 within the trade. So depending on your level of risk aversion and what you're looking to get out of the trade, you can adjust your trade accordingly, whether it's to put a price order in and to try to get out if the market in fact continues to rise and hits the 1280 area, or trail your stop up. Both have advantages, both have disadvantages. Silver. Well, silver has actually hit our first price target. Now, a move over 1958 to me is extremely bullish, and I think that we could see a continuing rise moving up to about $20 per ounce. We talked about the fact, and let's go ahead and try to compress this chart just a little bit. There we go. We talked about the fact over the last couple of days that we had really, really eloquent support in this area. We have this being a resistive area here. Of course, you get your parabolic rise and slow demise is how I put it the other day. But you can see quite easily that we've got an impeccably strong band of support anywhere between $18.80 and $19 per ounce. I don't think you're going to be able to buy silver that cheaply for quite some time. And if we do have this market take off, we've got tremendous room to the upside in terms of an upside target on our most optimistic scenario would be between $21 and $22, because as you can see here, there's really not a tremendous amount of resistance on a technical basis except this particular top right in here, which falls in at around $20 per ounce. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up and review on Friday. Bye-bye.